Hi everybody, in this video I'm going to have a chat with you around mortgage protection. First of all, what is mortgage protection? Well, it's exactly what it says in the tin. It's protection for your mortgage. So it's basically a life assurance contract. It's a life assurance contract that should you, or if there's two of you on the mortgage, one of you pass away, the amount that's outstanding on your mortgage will be paid by the life assurance company. So you pass away, the money will clear the mortgage. This is there probably not really to protect you, more to protect the bank. So it means the bank don't have to chase anybody for the outstanding debt. So let's use an example for figures. Let's say you borrow €300,000 over a 30-year term with the bank. They will require you to have a 30-year term with €300,000 worth of life assurance on it for the period of 30 years. Now, like your mortgage protection policies can decrease over the time. So let's have a look at the screen here and I can take you through a graph I have to try and explain it in better words. So as you see here, we have a client over here that has $300,000 worth of life cover. And then down here is a term from 3 years right to 30 years a term. In this case, decreasing cover means that the cover will decrease down to zero over 30 years. Now that's a rough example. In 15 years, on this basis here at 15 years, your mortgage will probably be in around, let's say, 150,000, and so will your mortgage protection policy. And all that this means is that simply you'll have enough there to clear your mortgage. But it doesn't have to be that way. You can actually take out what's called level term assurance. So if you're going to take out level term assurance, it means that 300,000 stays level for the 30 years. So if you were to pass away in 15 years and only have 150 outstanding in your mortgage, the life assurance company would pay €300,000. 150,000 would go to the bank and there'd be €150,000 extra there for your estate. To me, this is probably the best contract you should take out when it comes to mortgage protection. It's a little bit more costly, but I'm going to bring you through a few quotations now to show you the difference in a couple of seconds. So let's recap. You've got two types of policies: decreasing, which goes down over the term of the mortgage, or level, stays level over the term of the mortgage. Not rocket science and really easy to understand. Now, I should have mentioned at the beginning of this video, the worst place you could possibly buy life assurance is usually with a bank. And the reason is the bank will only be tied to one life assurance company. When you come here at Ask Paul, we've access to the big market that's out there. I'm going to show you on the screen what that looks like. So on the screen in front of you, you will see various different types of products over the left-hand side that here at Ask Paul we have to deal with in the marketplace. So we're going to look for, I suppose, term assurance, what we're looking for. So term assurance refers to basically the term of the mortgage, which can be decreasing term or level term, as you spoke about earlier on. In this case, we have 5 companies. We have Aviva, we've Irish Life, we've New Ireland, we've Royal London, and we've Zurich. All these products are actually really different, believe it or not. Now this is for the product that remains level. Okay, so when we look at the level term assurance in this case, let's just look at, for example, when it comes to the likes of children's cover, you see Irish Life and Zurich are quite competitive there at €7,000. Not nice to speak about, but it's in the contract. And also how long the contract can possibly last is really important as well. You see on this here, you see 89 years of age for Aviva, 89 for Zurich, but you see Irish Life at 84 and so are New Ireland, but then you see here that Royal London are up to 90 years of age. This means that you have the possibility of continuing cover up to 90 years of age. And to me, this is a really good idea. So when it comes to life assurance contracts, you're probably going to be price sensitive. A lot of people will go with the cheapest price, but as we know in life, the cheapest price isn't always probably the best for you and your current situation. So when we look at quotations, it's up to see what the difference is for these products. So I've run a quotation. I want to take you through it now on the screen, just so you can see the difference in the price. So in this instance on the page, we have done a product here for a quotation rather for a client called Joe Blogs and his wife Mary Blogs, and they're looking for 300,000 cover over 30 years, and they're both 30 years of age. When you scroll down here for the life cover, you will see the mortgage side here. The cheapest mortgage protection policy on the market is Aviva at €23.11. And you see next in here are Zurich, and then you see Royal London. And then also you see on here, you see what's called the conversion option. This means you can convert the policy to a newer policy during the term without giving fresh medical evidence, which is a really cool feature. Now look at over here on the life side. This is the level side, okay? So this is going to be the 300,000 level for the whole of the contract. In this situation, the cheapest product you're going to get with the conversion option, in my opinion, is extremely important. Cheapest one here is €40.60 with Aviva. You see, there's a considerable difference. It's nearly €17, but I think it's really good value for money because that extra €17 makes sure that you have that 300,000 right up. At this guy is 30 years of age, and so is his wife. So till 60 years of age, they have 30 years, 30,000 more, 300,000 worth of cover for the 30-year period, which is really, really important. Now, remember I mentioned the conversion option. When they get to 60 years of age, whichever life company you go for, yes, let's use Aviva in this example. Aviva will write to the client and say to them, your policy is ending. However, they're entitled to another policy from 60 up to 89 years of age with Aviva, and they don't have to give any more fresh medical evidence. So they get another €300,000 for a 29-year term, or just under 30 years in this case, to 89 years of age, and they don't have to give any fresh medical evidence. So when I talk about fresh medical evidence, this is really important, because when you get to 60 years of age, you could have had a few health complaints, and most people at that age find it difficult to get cover. But the conversion option means that you have a golden ticket that the life company must give you cover regardless of your health for another 30 years, or up to the max age of expiry, which in the Aviva case is 89, but in Royal London's is 90 years of age. So you're probably grasping already that it's not as simple as taking one product for one bank for one price. You need advice. You need to find out what the best product is to suit you and your circumstances. Now also, this is applicable if you already have a mortgage protection policy. You should be reaching out to us to review it, to make sure it's the best one you could possibly have for the money you're paying. And also, if you're considering going for a mortgage, if you're going for the mortgage with us here at Ask Paul, we'll obviously make sure you get the best cover in place to go along with your mortgage. Hope this video has added value. The main message here is that don't go to the banks, come to us when it comes to getting your mortgage protection policy. We'll get you the best product at the best price on the marketplace. Cheers and have a good day.